Good afternoon, ladies and gentlemen. I'm happy to announce the next panel, Retail Trading in the EU, Diversification or Consolidation. Please welcome our moderator, Rafah Hanna, Director of Rafah Hanna Limited, who will introduce the panel. Thank you.
Thank you very much. Welcome everybody and thank you for joining us. This is a very interesting panel because it's going to be diverse across a number of subjects that it hits upon. And so I'd like to introduce you to, well, I'll let each of the panelists introduce themselves. I'll start with Mr. Richard Barden here from CBOE.
Hi everyone, good afternoon. My name is Richard, as Rafah said. I'm part of CBOE's market data team and I help look after our market data services partners and clients across Europe and the Middle East.
Hi there, my name is Saleem. I work for the London Stock Exchange Group. I head up part of our business in the data and analytics part of the group. So just putting that out there right from the get-go that I'm not representing the exchange part of the business, I'm representing the consolidated feeds and data and analytics part of the business. Thank you.
I'm Joe Craven. I work for a company called TipRanks. We're a big financial data house and we have two main businesses. One is a retail-facing platform, a B2C platform that's used by about 5.5 million monthly users, which is a subscription freemium platform, allows individual retail traders to conduct their own research. And I run the enterprise business, which takes the data that is in the platform and provides it to big banks and brokers as an enterprise solution that's like a B2B2C product.
Yeah, I'm Richard Stoker. I work for CME Group, the 170-year-old derivatives exchange. I wear a few hats at the group. One of them is running the retail business here in EMEA, and that's obviously growing the distribution partners with our end users.
Super, thank you very much. So the panel really is, we're going to be looking at what are the retail trends what are the trends in the retail market. So based on the statistics, in the next 5 years, there has been an agreement that growth will be about 40%, which is phenomenal. So we're going to take a look at the unique characteristics. We're going to take a look at what opportunities may lie for the panel and for yourselves. And then we're going to try and predict winners and losers in terms of market share. And I think the first thing we'll see is that, that the market is very unequal, very clearly. So will we see some consolidation of small outfits leveraged out by the global players? And will that be on a geographical basis? Will that be on an asset class basis? So I think if I start, Richard, with you, what your perspective is, please.
Well, I think we're kind of already seeing that. I mean, for me, this panel should be called Diversification and Consolidation with an exclamation mark rather than a question mark. Because, yeah, I mean, the consolidation, we've got a huge business in the US in terms of retail. We've got a big business in Asia, which has been going since about 2017 after the kind of Shanghai and Shenzhen indexes started coming off. In Europe, obviously, we kind of compete for space with the CFD world. But I mean, the changes that we're starting to see now in terms of regulation headwinds, we've never seen before. And for me, I think this is more important than the ESMA rules that came in 2016. You're probably going to see some firms that if their business model is marketing the hell out of the platform and trading against a client, they haven't got a business, okay? People want diversification of products, people want education, people want sticky clients that are going to be there in 12, 18, 2 years' time. And that's only going to be real kind of access to the underlying market and the best chance of success. Also in terms of kind of diversification, it's other asset classes. And whether it's kind of crypto, options, futures, whatever it is, that's where we're seeing the biggest success. But you never told me we were going to talk about winners and losers.
There's a few questions I didn't tell you about. But I want to go to Maz, because Maz, you're in a sort of a unique position in terms of the LSEG group itself. The Refinitiv side, the LSE side, the exchange versus distribution, and distribution rather than versus. So what's your take on that, please?
Thank you, Rafah. So I think we're certainly seeing the consolidation side as well as diversification side. So I'd agree with that comment that we're seeing both of the above. I think if we go back a few years, there were a lot more, let's say, smaller upstart types coming into the market, and the type of conversation we were having was a different conversation. It was more around supporting them, earlier in their journeys. I think at this stage we're definitely seeing a lot more around the bigger players, either taking that market share and seeing that consolidation, or we're seeing a lot more requests for white label services, whereby some of the larger players can provide effectively an out-of-the-box solution for those other organizations that want to, effectively market into a new geography or so on. On the asset class side as well, we've seen, a major expansion into the likes of crypto, even into cash and options as well. So yeah, absolutely, we're seeing both of the above, and in terms of the way we see this, we do see it growing as well. I think there are some comments around the growth being up to 40% going into the future. It's probably going to be less players, but absolutely the growth isn't about to slow down.
Great. Joe, you have a unique perspective as well on the panel in terms of your business model. How are you seeing that? Because you're serving millions of retail end users each month, and that's a very strong recurring model. How are you finding that in terms of, are you looking at diversification? Are you looking at consolidation?
Yeah, I have to agree, firstly, with my two other esteemed panelists here, in terms of the fact that there has been more movement into larger businesses, and that there was, going back, I would say, pre-COVID, and then during the COVID lockdown, an enormous influx of firms looking to capitalize on the stay-at-home trading. And so volumes were just very sky high, and a lot of firms were trying to capitalize on that and diversify their product offerings to encompass the retail requirements. I actually think that there will be, as my panelist said, consolidation. I think that the big firms that have established themselves nice and early, firms like IG Group, firms like Revolut, very reputable and sizable, will inevitably take on more clients. And the ones that came late to the party in that COVID boom will start to suffer as volumes do come down. So consolidation, definitely. In terms of actual product diversification, FX seems to have gone down in volume, and perhaps in line with the reduced volatility. Equities have been very, very much busier, with the CFDs playing a big part of that as well. And investing, and the fact that forex is more speculative, has encouraged more people for the long term to be equity investors, and that's cross-generational, as well as the fee structure of ETFs. As a company, TipRanks has added, from initially being very equity focused, ETFs analysis and crypto analysis, and in terms of, as you were saying, the retail investor, diversification into cross assets has been very, very large. And into your point of growth of 40%, I think that that's a good, reliable figure. And I think that one factor that I would state backs it up is that there's going to be an enormous wealth passage from one generation into the next over the next 10 years. And in that passage of wealth transfer, it's going to a generation of people that are much more digitally savvy, much more cost savvy, and much less likely to put their money into fund managers or mutual funds, and more likely to go into their own investing.
Those are great points. Thanks, Joe. Richard, the CBOE has gone from a platform, a venue, an exchange to now a global player in terms of what you're doing in Asia, what you're doing in North America, what you're doing in Europe. Really, you're innovating as well as expanding. How would you answer the same point in terms of the consolidation of the players, because you've been the one that actually been actioning this.
Well, I wish it was me personally, but sadly not. I mean, in terms of, yeah, as Richard was saying, maybe it is diversification and consolidation. But I mean, from a diversification point of view, the one thing that, and you would expect me to say this coming from a derivatives-heavy exchange, is we are seeing more interest from retail brokers in Europe in derivative products, not just futures or CFDs on futures, but options. So we've actually had some meaningful conversations. I've been with the company now about 5-6 years. The first time I can remember, with some retail brokers here in Europe, about looking at options as a product set that they may want to introduce next year. So that's quite an interesting trend of diversification. Whether that's being driven by the fact that they see options as a great product for retail trading, which you can argue, or whether they are simply being very cautious and looking at options as a possible long-term regulatory hedge if they feel that the regulators will tighten leverage trading requirements, and therefore it will make it much easier to offer a leverage product like options in that sort of environment. So mimicking what's happened in the US, where obviously you can't trade CFDs, which is why everyone is trading options. I don't know the answer to that, but hopefully we see that trend continue. In terms of consolidation, yes, you're seeing that already. Smaller brokers are being, I won't say snapped up by larger brokers, but there's more sort of broker networks being created. Also, though, you can't tell where the next disruptor is going to come from. There are an awful lot of small fintechs out there, small neo brokers. One of those, I'm sure, over the next 5 years will be, will take a certain chunk of the market, and it'd be interesting to see how that pans out. I'm not going to name any winners or losers.
Okay, not yet, not yet. I mean, which leads us on to, because Joe, you rightly said that clearly during the pandemic, there was a stay at home. People still wanted to make money. They had more time and less travel, and they were being paid, and so therefore they had a greater disposable income in many ways there. And of course, the exchanges had to act and react. Things changed instead of commission structures, payments, in terms of market data licensing. It changed instantly and overnight. It wasn't a process, it was an event. So what drives the trading, really, Richard Stoker, to you, what drives the volumes, and have you seen a difference in geographies in different markets there? And is it also the case that now you've got more professional type data that's available to the retail end user rather than those that are working in financial firms?
Well, I'd say it was two things. I mean, one of them, it's never been easier for a retail trader to get access to the underlying market and the intelligence and the information that's out there that used to be the preserve of the hedge funds and the asset managers. This is now available on the streets. But I mean, you're right, 2020, I think all the brokers here, we had a phenomenal year, and that kind of continued for us in the retail space. But where we kind of focused our attention was not really just hoping for volatility, which obviously you can't predict, was just really kind of rolling out products which are relevant for the retail audience. So I mean, obviously everybody knows us for our kind of EMEA S&P, our kind of NASDAQ, Dow, Russell 2000 equity products, FX, crude, gold, all the asset classes that we have. But what we did was focus on micro-style products which the self-directed individual trader wanted to trade. So they was basically a tenth of the notional of the standard size. So we've now got micro products in 19 of our bigger brother products now. We've now kind of, to Richard's point as well, I was on the main stage last year. I think you were, Rafah, as well. I was asked kind of predictions for 2023. I said, for me, it's going to be the growth of options. And that's exactly what we've seen. Both CBOE and myself, or CME Group, I should say, have seen a kind of growth of about 30 to 40% in options. And that's coming from near-term expiries, the kind of new daily type options that you've been hearing about. And that's where we've kind of piqued the interest of the retail audience. And what we've done is really, as I say, kind of listen to the client base and kind of found products which were relevant for them rather than trying to solve a solution for a problem that didn't exist.
That's good. Joe, talk us through that period and what's happened in terms of your business, because there has been, there's no doubt, phenomenal growth relatively in each of your businesses on the stage, but especially you, because the cost of acquisition and the retaining and is very high at times.
Right. Well, what we do really at TipRanks is keenly directed towards the retail investor and leveling the playing field for the retail investor by extrapolating and taking really complicated data that's in the marketplace, the sophisticated data that professionals at hedge funds will use or asset managers will use, and then synthesizing it into very easy to use graphical tools that allows the average Joe or Jane or whoever to conduct their own self-directed research with the same level of accuracy and data integrity as the key professionals, but in a much easier, more user-friendly sort of manner. And to give you an illustration of one of the products and tools that we have, is we take analyst recommendations from all the big companies, the Barclays, the Morgan Stanleys, you know, the Goldman Sachs, etc. We consolidate all of their equity and stock-related forecasts, and then we produce a simple graphic on a pie chart showing, is it a strong buy, is it a strong sell, is it a hold, who is rating it as a buy, who is rating it as a sell, what is the forecasts, what is the potential high for the next 12 months, and what is the average of all of those analysts. And again, this is information that if you're they're not on the panel, so I can say a Bloomberg of this world, you know, it's costing per terminal $1,500, $2,000 per user. Whereas at TipRanks, our platform, the B2C, is $20 a month per user. So it's really an absolute fraction. And on a B2B, if you were to click into one of our enterprise clients, Santander, CIBC, TD, there's Morgan Stanley, there's a lot of big banks in there and brokers like Robinhood as well. If you were to click in and use our tools through one of those platforms on a B2B2C basis, the cost of acquisition of our data is somewhere between 10 and 20, 30 cents per user on those platforms, as opposed to, you know, our competitors, which is 1,500 per month. So, you know, we're really disrupting the space of alternative data for the retail investor.
It is, and I think it's important for our guests to understand that these are new businesses. They were not around to this extent 20 years ago.
Right.
And exchanges have all had to come up with innovative policies and commercial guidelines and market data licensing as well for all that. Because it was always terminals, feeds, pretty much, and slicing and dicing how we use that. I want to go to Richard Barden, because again, you know, CBOE is very diverse in terms of geography. How are you seeing volumes, and how are you planning for that?
Good question. I mean, just going back to some of the other points before I answer that some of the other panelists were talking about. I mean, we've always been retail friendly from a data licensing perspective. You know, we don't typically, certainly on Europe and to a small extent in the US, really charge end user fees. So we've seen a lot of retail banks and brokers using our market data because of that to help, you know, further propagate real-time data, you know, to obviously increase the trading on their platform. But equally, that's made real-time data much more freely available, and hopefully that has benefits for retail traders. In terms of sort of,
sorry, can I just intervene just quickly? I just want to make it fair. So on the CME, on the derived data, there is no concept of end users. There is no policy, so there is no end user. CBOE is the same. There is an unlimited and a huge multi-10,000 limit on those. And on the LSE Group's alternative trading platform, it's the same. It's a semi-tiered system. So you can see there's evolution, is what I'm trying to point out in terms of the policies there.
yeah, yes, as I said, we're all to some degree chasing the same goal. I would say some of us have got there quicker than others, but that's the nature of competition. In terms of where we're seeing growth, yeah, I mean we've pioneered the zero DTE, 0 days to expiry market in the States. So with the S&P 500 index options, that's a very retail-friendly product and has seen big growth. Equally, we're trying to do the same here in Europe. So we've got a European derivatives exchange that's offering free real-time data and is trying to help make it much easier for firms across Europe to trade in a low cost and simple manner a range of futures and options.
Thank you. Maz, you've got the index side, the feed side, the exchange side, and the vendor side. So please, your views.
Sure, thank you so much. And I think the view that I'll be in a position to share is sort of sits a little bit differently to, at least from the exchanges, because we, on the data feed side, we don't get an insight into the volumes. We do get an insight into what's of interest. So, it may be that there are some things still being tested and so on. And that's where, the fact that we've got connections into every single sort of asset class that there is out there globally, it puts us in a position to be able to provide that. I think one thing we've seen, if we go back 5 years compared to now, is the respect given to the more professional retail investor. And, our customers are asking for us to, or looking for solutions to be able to attract them by giving them some of the things that we talked about, with some of the others that have spoken today. What that's meant for us is that we've gone from, say, 5 years ago, where we would provide more raw data, and really it would be down to our customers to, and generally they would just, derive it and share it. And it would be typically more basic data, price, volumes, those sorts of things. We've now moved into an environment where there's a demand, and actually we're capable of fulfilling that demand because of the changes we've made, of more advanced data. Things like news sentiment, things like some of the things that were talked about earlier around analyst recommendations and just other alternative interesting data sets that typically only professionals would have access to, but it creates an environment for the end customer, to feel more confident in their decisions. It puts the broker themselves in a position where they can demonstrate that they're giving their customers better tools to be able to make good decisions. So, regulators can feel more comfortable that customers are being treated nicely and fairly. And from our perspective, it allows us to scale the things we've been providing and selling for years and years. So, now it's an environment whereby, rather than just providing, let's say a raw textual news feed, actually we're in a position where we can provide sentiment analysis ready built, or, certain types of charts ready built that then fit into some of the GUIs or the UIs that our customers then put in front of their customers.
That's very clear, because what you're saying is that there are now what were ancillary services, such as cloud history in the cloud and visualization, as Joe's been talking about, the charting part, which is oh so important. And I guess it leads to the question that how you're each contributing really as market data businesses in many ways.
So I'll stop you there quickly. So I wouldn't say CME Group was a market data business.
No, as
Obviously,
part
but
of.
as part of,
Yes,
yes.
part of the
And
group.
I think that's an important thing to say, because I think there probably is a misconception from some of this crowd kind of in the retail space that some exchanges are kind of market data providers. And yeah, that is a fantastic kind of core part of our business, but it's probably about 10-15% of what we do. CME Group is obviously as a transactional business, and we clear about $330 billion of notional a day. So the core business is kind of financial derivatives. Obviously, bolted onto that, we have a very important the market data side. So just to make that clear.
No, absolutely. Thank you. Thanks, Rich, for that. But in terms of specifically that, so how are you contributing to the lowering, or even, if I dare use the word, eradication of the barriers to entry for execution services? You're using market data as part of that, of course. That's part of the tool set in that respect. So Maz, if I can start with you, in terms of lowering the barriers, you mentioned some already, but again, on the retail side, it's almost like learning to put your coat on with the other arm first going in.
Yeah, definitely. I think we're in a position actually as part of the data and analytics group that's, it's a nice position to be in, because actually much of what we would need to provide to retail brokers in order to reduce those barriers to entry, as I kind of hinted at earlier, we've been providing to the professional community for many years. And we're getting so many different types of angles being inquired about now. So, as part of our group, we cover all different types of data across the latency spectrum, from low latency right the way through to end of day. And unbelievably, actually, over the last 12 months, we've had several inquiries regarding low latency data analysis, whether it's historical or whether it's, for ongoing co-located data feeds, and out from the retail space. So I think it's fair to say there's a lot of innovation out there, and the position that we're in, because we're so central to the market, in that we connect and provide so many different types, we end up getting exposed to those different ideas, so to speak. And from a barriers perspective, we've had a very advanced cloud strategy anyway over the last few years, and I think what we've moved into in terms of tangible benefits for our customers, things like storage of data in the cloud, as well as compute, graphics, and so on, built into the cloud, so that you're not having to set that up, for yourself. Those have massively reduced those barriers and actually opened up customers to analyzing things like the tick history and even some of the lower latency part of the business.
Thank you. Joe, you have a lot of strategies in your business. You have a lot of options, really, there. Talk us through what your view is in terms of, because lowering the barriers is a part of the business model itself.
Yeah, absolutely. And you really have set me up for a nice question, because we're all about. It's thank you for that, because we really are about retail investors and about the barriers of entry. And that's why we run this B2C platform. As I mentioned before, there's 5.5 million monthly users or so. And at the base level, it's free. So anyone can sign up for TipRanks.com, there's my plug, with their email, and they can access an enormous wealth of tools, literally for free. If they want to have a more sophisticated, real-time, again, as Maz was saying, the difference between latency and not, but so real-time approach, then they can sign up for a premium. And if they want to have the ultimate experience, that's marketing speech, but we call it the ultimate account, then they can sign up for, I think it's $50 a month for that level of service. So our mission has been to democratize self-directed research for the leveling the playing field for the retail investor, and as such have made it available free at its most comprehensive level. Saying that, and again to back up what Maz was saying, at the most sophisticated level, our raw data, which has been traditionally the bread and butter of the institutional exchanges, our raw data is now being used by hedge funds. And obviously, what a hedge fund pays for our raw data and analytics is massively, significantly more than what you or I would pay for the access to the platform. But in essence, they can trade off that with their algorithmic trading systems and it produces alpha for them. So again, catering for the masses in terms of barrier reduction is really something that we've made our home.
It's great because you're a service provider of service providers, if you like. To Richard Stoker, I mean, you mentioned the 300 billion notional a day.
Just 300 billion.
Just 330 billion, pardon me. Can you split that between institutional and retail, or sort of retail maybe?
I could, but I'm not going to.
I did try, ladies and
Yes,
gentlemen. I did.
but what I will say is that our growth is this year and over the last 2 years has been probably front and centre from the retail audience. We've actually got, I mean, these conversations, as you can imagine, we've been going on since like 2018, 2019 about kind of launching futures on certain retail platforms. Then obviously 2020, 2021, everyone had such an influx of money coming into their CFD platforms that got put on hold. But we've actually got 50% more brokers launching futures in 2024 than we've actually currently got. So futures is becoming a bit of a kind of buzzword in the retail crowd about, as I say, kind of going back to the title of the panel, diversification. And that's what we are seeing. The other thing that we're seeing is kind of on the crypto side, CME Group actually overtook Binance 2 weeks ago as the world's largest crypto futures exchange. We overtook Coinbase about 2 months ago, and that's really because institutional flow has to go onto a highly regulated, institutionally focused platform. Okay, so all the hedge funds and asset managers, if you're a hedge fund, how can you explain to your clients that you've lost all your money because it's been on an unregulated platform? I mean, that's pretty unforgivable, right? So after the collapse of a kind of certain firm back in November last year, we saw all that institutional flow come onto us because we are CFTC regulated, and they just want price exposure rather than having to have the physical asset. And I think that's important for our kind of our asset class based on the crypto side.
Well, just following up, a follow-up question to you on this. What's the end game in terms of you're overtaking the challenger and innovative venues, let's say. What's next for you?
Well, what's next? I mean, we listen to the clients in terms of what products they want to see. So I think you'll probably see going forward more rollout of kind of micro-style products, more kind of rollout of zero data expiries as Richard's got. I mean, we've got them every day in the equity markets, 3 times a week in metals, energy, rates. And you'll probably see more of this going forward. I mean, we do have some limitations, obviously, because we're regulated by the CFTC, as I say, but we're certainly listening to the customer about what they want to see going forward, and we're kind of very nimble to kind of act and react to that.
Rafah, I'd just like to jump in just to clarify from a TipRanks perspective. Unlike my esteemed colleagues here, we don't provide any liquidity. So we don't provide a platform for retail traders to trade through. We don't have links in to facilitate trade execution into any exchanges, etc. We are purely an information portal. So we would be a customer of the various exchanges here and ensure that we take the data integrity from them and provide it then to our users, but not facilitating them to actually go through us like a broker to trade then with a platform. So
that's clear. Thank you. Richard, do you have anything to add? You want to add?
I've almost forgotten what the question was now, Rafa.
How do you contribute to lowering of the
Okay, all right,
execution?
okay. I mean, data's a big part of that. Cost, again, banging the same drum, but we I wouldn't say pioneered, but the exchange, certainly here in Europe, has always had a very sort of contemporary view of market data licensing and costs. No end user fees for retail clients as an example of that. And we know that that's popular with retail brokers. We have an awful lot of retail brokers who license our market data. And they also daisy chain it down to lower tier retail brokers, again for precisely the same reason, that it's affordable. So yeah, I hope that our approach to data fees has been an input, hopefully a significant input into helping facilitate more retail trading, certainly across European equities.
Thank you. So Sort of penultimate question. Firstly, I'd like to go to the audience. Are there any questions, comments, observations anybody would like to make? No, everything is clear. Stunned silence, like in a classroom. All right, that's okay. So I think what I'd like to understand is that most of the brokers downstairs started out in the FX world by, in the 90%. They then evolved into this thing called CFDs, and because in the US it's not allowed, of course, at the moment, and so they're regulated in Asia, in Europe, and the UK, and so on. Here, is there a correlation? Question to each of you between FX and CFD volumes. Is there any sort of link between them? Does one cross-subsidize, cross-pollinate the other one, or not? Richard, Barden?
It's funny you should say that. Yeah, so it was funny. 5 or 6 years ago when I first started doing this, a lot of brokers were sort of, dragging themselves to have to sign up for equities. They felt, I've got to go I've got to do this multi-asset thing, so I've got to sign up here. And they weren't used to paying for data for a start, because FX was traditionally given away for free. But more and more, they are increasingly, I wouldn't say happy to pay, but they understand the relevance of having a broad asset, a broad range of products, a broad range of assets, and the costs associated with that. And whether that's and how that will continue, I think will across other asset classes, other products, new products. I think you'll see that continue. The landscape has changed. I think a lot of the brokers recognise that they, have to be diligent, they have to be compliant, thanks to people like yourselves, understanding the value of data licensing. Even if they have all started out 10, 15, 20 years ago using FX that was given away for free, I think they now recognise that the landscape has changed, and whilst they may not be happy to pay for data, they understand that they have to pay, and they understand the value that transparency over where their data comes from and the integrity of the sources behind that is increasingly important to their business.
It is. Just to give the audience, those of you who may be mildly interested, 10 years ago, market data for CFDs was a flat fee basis, if there was a fee, because they didn't really understand, and this thing called derived data, where you can't back calculate or reverse engineer it, so it's a new price, in other words, and the brokers were claiming the intellectual property on that. Fast forward to today, you've got some very complex models about this, where it's per API, per geography, per number of products, type of client, if it's going through execution engine, if it's going through a meta quote, whatever it may be. So it's far more sophisticated these days, and the majority of the brokers do not have a thorough and detailed understanding, and nor should they, of market data and policy. It's a very complicated, sophisticated place. And I think that's just building on what Richard was saying in terms of that. Maz, what's your view?
I think what I'll share is the fact that there's more of an understanding from the broker community around the value data can bring to their business these days compared to what it used to be. So, I mean, the direct question was around volumes, and given that I'm representing the data and analytics business, that one I can't necessarily answer, but what I will share as some useful information is around, let's say, FX. So FX, as we know, as Rafah mentioned, that's been part of this market that's been around for a long time. The data was, let's say, relatively easily available and so on. Now, I don't know how many of the audience will know and appreciate this, but as part of LSEG Data and Analytics, we've got the FX All and the FX Matching business, which are the primary and one of the main secondary markets in FX trading. And what we did is we built out FX data feeds as a result of that. Now, when we talk about FX data feeds, I'm not talking about G10, right? I mean, those sorts of rates very easily available and so on and so forth. But any of the more interesting, exotic cross rates, those are less so available. and we've definitely seen more of a desire for that higher quality market data to go into the calculations or the, let's say, the operations of brokers, such that it can benefit the downstream customers and their own execution. So I think that, even on that part of the market data, because we talked a bit before about how paying for data has become something, more from recent years. It's now, there are some examples where even if the data is available for free, the quality makes a sufficient difference that voluntarily we're seeing people wanting to pay for certain types of data.
The provenance of the data is key, whether it's trustworthy, whether it's, if you have a exception report, whether you have a problem with a trade, you want to be able to reverse things. Richard, your view?
Sorry, just to mention,
Yes.
so agreed, right? And also the accuracy, because the spreads can be so wide with some of these currencies that it makes such a big difference when you know that this is the rate that banks are transacting at, and actually you can then get insight into that compared to what you're being offered, compared to what you're offering to your downstream customers.
It's a great point. It's a great point.
So I'll answer that in two ways. Obviously, one of them, talking about sort of pricing of data, derived, distributed, whatever it is, obviously we try and make it as easy as possible. I mean, we do have some kind of members of the market data team here, so I would just encourage people to come and talk to us. Obviously, some people like to go through consultants, obviously, which is absolutely fine too. But I kind of also flip the actual kind of pricing of FX specifically with prices of FX. And I think the main issue is the disparities sometimes between the underlying price and the price that you're starting to see on some of the wider platforms, especially under kind of times of stress. So if we go back to the kind of the Trust mini budget last year, I think the actual futures low was 103.94. Most of the kind of tier one retail brokers were probably pricing in the 102s. A lot of people were getting filled at parity. So I mean, kind of how do you keep that client that's got stopped out at parity before he wakes up and it's back trading 108? I mean, I was still trading back in the days when the Swiss peg went on, and we stayed open all the way down. And we kind of some fantastic feedback from some of our kind of like biggest clients that could actually still kind of manage their risk all the way down. The Swiss kind of depegging, the Swiss depegging, we kind of went into some volatility stops, but again, we kind of stayed open. So I think that's the most important thing. If you're kind of a liquidity provider, if you're an end user, if you're an exchange, making sure that people have got access to that underlying price.
Thank you. Joe, you've got 22 seconds, 21, 20.
Okay, now I'm very cognizant of the fact that there's very little time, other than to say the question about volumes and CFDs. My view is that the volumes will always go through the underlying market first, and in the case that you're mentioning, FX, and then we'll go through CFDs afterwards. It's very rarely the other way round. And more interestingly, I think CFDs are now more widely available on a greater level of products, financial instruments, than typically, as you said, were available in the 90s. And now are beneficial for institutional investors on a tax structure basis to actually trade CFDs, because they're considered as a form of gambling still, so that it's not capital gains related. And that will also increase the volume that's traded through CFDs, not just for retail investors, but for institutional.
Thank you very much. Just leaving that, thank you very humbly, all of you. Thank you all for giving your time up. We appreciate it. Please do thank the panel. Thank you.
And our host.
And Rafah, indeed.